Okay, we're live. Don't worry, it's not going to just be me here. I'm just here to welcome you, make sure all of our Bank on Yourself professionals are in and behind the scenes. This first little bit, really only people that watch the recording get to see. So, welcome. Thanks for watching the recording. Really glad that you're here. We're going to have a lot of fun. I see now, okay, we got through that first 20 seconds. Thank you, recording people. For those that are showing up live, we already got a bunch of people here ready to go, ready to see some awesomeness about banking. Wow, on a Friday afternoon, you're showing up to talk about banking. Thank you so much for being here live and for being on the recording, whatever time and day it is. Thank you so much for being here too. Okay, join me. Drum roll, please. Welcoming the rest of the Bank on Yourself professionals crew for today. Oh, wrong one. Got a behind the scenes person here managing things. I'm going to move around a little bit. There we go. What a beautiful crowd here. And we got
Hey,
lots of
everybody.
people already joining us. So say hi to the crew too.
Glad to be here. Thanks for having us.
Go ahead,
I think
Brandon.
we got Mr. Ben Barry
Hey
coming
there.
in too.
Hey, Allie. I see Ben Barry's coming in too. Cool.
You see some
All the
people.
cool kids. Right on.
Yeah. So, thanks guys for joining us. This is going to be a lot of fun. We are talking about one of the best topics in the world, banking, but not
There's
in a
Ben.
way that is, I don't know, kind of terrifying. Anyway, as you can see, we don't have just us and Mark. We got more guys here. We need to get some girls. I think we're
I'm
gonna
working on it.
next month. I think we're gonna have some ladies in the house too. But today we got Mr. Mark Willis. You guys know him if you're on our show or on his show. You know Mark, Not Your Average Financial Podcast. Then you got Evan Greathouse. If you want to say your business name, I always forget these, but Evan is in our world too, doing some amazing stuff, and he is killing it. And then we got Mr. Ben Barry. You saw Evan last month, and Ben is new to our show, but he is not new to the Bank on Yourself world. And of course, you have Miss Amanda Neely, who knows. Oh, she's representing the female world. We got to get some more girls, though. This
Women.
ladies, more women. So, anyway, thanks guys for being here. Let's have some fun.
All right.
Yeah, let's do it.
All right. So, Amanda, would you like to kick off the introduction of what this is all about, why we're doing this, and where the pieces fall, or would you like me to give a greased slide into the conversation?
Well, I will maybe just let everybody know we might nerd out a little bit today about banking, and for a very important reason, because it really does impact us every single day. Whether you have a bank account or not, the banking industry does a lot and controls a lot and has a lot of power in the United States and around the world. So this is something really important to understand a little bit of the mechanics behind it. But then I think we're going to get more into like the changes and what those have meant for us and could mean for us going forward. Now,
that's right.
Yeah, now you can get more into the nerding.
Well, and I'm going to pass the ball because it's all about passing the plate of brownies. So to mix metaphors there. So most of us just engage the banking function in our life almost like, it's in the background. It's a commodity. We have a checking account. Maybe we do Zelle or Venmo or something like that. But we don't ever think about the pipes undergirding the system that makes our everyday life possible. Everything I've eaten today, everything I wear, the lights in my house, it's all because the banking system is working. And if it stopped working, then everything about your life would stop. And last spring, 2023, we had another close call. It's not the first and it won't be the last. where there were bank failures. There were some big bank failures, and we've had more in the past. In 2008, 25% of all banks went bankrupt. Let that sink in for a minute. Okay. There were roughly 500 banks that went out of business. There are about 2,000 banks, whatever, that are in the system, not just bank branches. I'm talking about entire banks. Now, and then you go back to the Great Depression, and it was even more. It was close to a third of all banks went bankrupt. So what would happen? And more importantly, where are you going to put your money so that you can protect and maybe even take advantage of that situation when it happens again? Not if, when it happens again. So let me pass the ball over to somebody else. Ben, I'll let you chime in since you're our newbie here today. You're not a newbie to financial strategies. You're not a newbie to thinking outside the box in all areas of life. But why don't you jump in on this idea of the, quote, safety of banks? Are they really the safe place to put our money?
Yeah, that is a great question. And I think, part of it goes back to the whole question of kind of what you just said, Mark. Most of us have money in the banks and everything flows through our life because we've got our money flowing through there. And I think it kind of goes back to that question of, where you put your money makes it do different things, right? So when we have our money in the bank, it's going to have it, cause our money to do different things. Like maybe we've got a savings account. Maybe that's picking up a little bit of tiny little bit of interest there in that savings account. But I think we just have to think. We got to think about some of the things in our life, like our banking, like our money. We don't even think about it. It's just there. It's what every single person does, and we take for granted that it is safe, right? We're on this street, and our kids are all playing around, and we'll have other parents come by and be like, you got to be careful because there's cars coming up and down here. And, sometimes we can just, as parents, whatever, you can take for granted that you live in a safe neighborhood. But when things change, you have to be aware. When things change, you have to be aware, right? So the same is true with banks. The same is true with our money. Don't just take it for granted that your money is, safe in that bank. You don't want to be alarmist, right? You're like, oh, and everything is bad, blah, blah, blah. But you do want to be aware. What is going on in the economy? What is happening with banks? So sorry, I'm not really answering your question, Mark.
Well, Ben, you said don't be an alarmist. I want to ask a question. Yeah. If we were all turkeys on a farm and it was November 27th, should I be an alarmist? I am being fed well.
Yeah.
I am taken care of by the farmers. Mm-hmm. I am given a nice place to sleep. I have a reserve, okay? Mm-hmm. Meaning I am fat and happy and there is a reserve of corn or whatever I eat. But it's November 27th. What's coming around the corner? Mm-hmm. Let's say it's the fourth Wednesday of the month of November.
Right.
Now, what happens on the fourth Thursday of the month of November in the United States? Anybody know? Thanksgiving, right?
It's that shopping
Should I be an alarmist in that scenario? I want to know. What do you guys think?
So I have to add, so I used to work. I don't know if you guys have ever worked for a bank, but I worked for two of them. And I worked for JP Morgan, and I was on the help desk side. So most of my job actually went to India and outsourced and all that stuff. And that was that 2007-08 time frame, somewhere close to that. But I remember as we got married, Amanda and I ended up working for another bank called Chorus Bank. Now, with that bank, they were doing some shady deals, which I kind of felt like that was happening as I was working there in the IT department. I was like, something is off here. Something is really off here. And they were I believe, and I'm pretty sure, selling swampland in Florida. Something very similar that happened in the 1920s. And then all of a sudden, 2008 hits, and this bank went under. Had to get bought out by another one because they were selling things that were not. They couldn't hold true on their promises. And I'm pretty sure the CEO disappeared to the Caymans or something. Right. And so I've seen it firsthand when these banks are stupid. And just the guy's driving his Ferrari and Mercedes or whatever, I don't know. And we have to be, they should be held to a different standard personally than the average American. The problem is average American, in my opinion, we're told to have a good foundation, build a good savings, have some emergency. But yet we're told in the banking world, don't worry about it. Just let it all ride and do all kinds of crazy stuff. That's what we're talking about is we used to have some of that. Now we even have less. And we had a 2008. I don't know what's going to happen soon, but it's happening more frequently. Sorry, I went on a rant because
get Brandon talking about his history of employment with banking. There could be some people watching over on Facebook that are missing some of the comments on YouTube. Highly recommend going over on YouTube. We got some great comments. Just to recap here before we jump in too far, we had a great question from, where is this? Tali. How many credit unions went bankrupt in 2008, I assume is what she was talking about, because Mark shared there were 500 banks that went bankrupt that year. And I looked it up. I actually, with the help of a search engine, and I found 19 consumer-owned credit unions failed in 2008. And there's I put the link so you can check it all out there. What we're going to talk about with this zero reserve requirement, this is going to apply to both banks and credit unions. This was a sweeping law that changed for both types of institutions. It's not always true for all banking regulations. Credit unions are sometimes treated differently. They have different, protections and different things like that. So thanks, Tali, for bringing up credit unions. As we get further into discussion, I wanted you to have that heads up that we're talking about banks and credit unions when we talk about this reserve requirement.
Wow.
And before we go any further, thank you guys for watching on YouTube. Write those comments, share these videos. That really helps us get the word out more.
And hi, Beatrice, too.
We really appreciate you guys as you tune in on our channels, whether it's NYA Financial Podcast, YouTube, ours. I'm sure Ben and Evan will have a podcast soon. But we really, really appreciate it. And write comments, share this. Share all our videos, of course, because we need to change the world.
So there are, according to data I could find recently here from MX Technologies, this is as of April of 2024, the top 250 banks in the United States, and again, there are over 4,800 total banks, but the top 250 carry a total balance of deposits of somewhere around $7.6 trillion. So all of our bank deposits, if you put, the top 250, it's going to be about $7.6 trillion. Now, we all think that the FDIC is a gold standard for safety. Okay, so, right? Like when I walk through the bank's door, there's that nice little sticker on the wall that says, we are FDIC insured. You can feel comfortable putting your money in our bank vault. We'll talk about the vault in a minute. What percentage of the 7.6 trillion is actually on reserve at the FDIC? So the insurance company that's supposed to back up the banks, if the bank fails, how much of your bank deposit is actually insured? Or put it another way, what percentage of banks would have to fail in this country for the FDIC to be empty? What percentage?
Should we share screens and show people how to find it?
Put a poll up if you want. If you want to, Amanda, what do you think? What percentage of your bank deposit?
Yeah, share in the comments.
Yeah,
I don't think
in the comments. Yeah.
What percentage? Here's the question: what percentage of bank deposits in the United States are FDIC insured? And while they're
100%.
doing that, what do you guys think, Evan? I'd love to hear from you, my
So
friend.
is it 100%?
100%. Every dollar is backed up by the FDIC. Well, we all think it's up to 250,000, right? Like we think that would be, that's what they claim, and that's what the promise is. It's
Yeah,
that's
up
what
to
you would hope.
250,000 per account.
There's something called a bank run, though, and if that happened, I wonder if that would still hold true. So, something for sure to consider. No, I'm loving this conversation. I think it's something that hasn't been talked about nearly enough. And there's a lot of people. Like I was talking with a family member of mine about this, just kind of in preparation for this, just getting other people's takes on what they thought about, hey, this no reserve thing. And they said, well, I haven't carried a single dollar in my wallet in like 4 or 5 years. Like I don't really need banks. I was like, well, so just because you don't have cash in your wallet, does that mean that that's not going to affect you if like something did happen with the bank that you were at? What if you weren't able to access your dollars even through a debit card or whatever? So anyways, there's a lot of discussion that needs to happen just so that we can make sure everybody's aware of how that would affect the economy and your personal well-being.
Okay. No, that's exactly. It's interesting. They say that they don't use a bank if they don't have green stuff in their wallet. But how do you buy your latte? How do you buy your groceries? How do you pay your light bill? How do you
Credit card.
Run the gas in your car or whatever? Yeah, credit card. And what's that tied to? A bank.
A bank.
So I'm seeing some comments. I see someone says 20%. Thank you, Julia. Catacomb XYZ says 50 5/8%. Show us the source on that, because that is extremely accurate. Maybe he or she's doing Price is Right style, like just a little bit of. And then 3% says Tally. Great answers there. Troy says 3%. Alan Porter. Hi there, Alan. I need to give you a call, by the way. 10% says Alan. So wow, we got all kinds of from 3 up to 50%. What do our panelists say? What would you guys guess?
I think we can all agree it's
0%.
not 100%.
You don't think it's 100%, Evan, for real?
I
don't-
already know the
I don't think
answer,
so.
so I can't.
Okay,
I
Amanda.
can't participate.
Anybody
I
else
mean-
want to jump in?
Didn't we say no more? Would it be 0?
Well, that's the reserve requirement. We're going to get to that in a minute too.
Okay.
But FDIC's reserves, well, what is like if you had a house worth $1 million and you had to insure that house, if that house burnt down, you would hope that the insurance company could replace the value of your house. So you'd need that insurance company to have at least $1 million to replace your house. So I'm kind of giving away the game with my reaction here. Amanda, what
Here we
what
go.
is it? What is it?
You ready? Okay, so this is
Drum
The
roll, please.
FDIC insurance website. They've got some great analysis, and you can go find their quarterly banking report. This is the last available for Q1 of 2024. And I scrolled down here, and they have this Excel sheet that is their deposit insurance fund, reserve ratio, and balance. You ready for this? So I downloaded it, and then here it is. This is showing it from 2008 to 2024. It's never gotten above, like 1.4.5% or so. And it's been negative in the past.
And where, what happens? This is so first of all, shocking. And thank you, Amanda, for backing it with some real stats and source material. Thank you. It's better than just us pontificating. You're amazing at finding the sources here. So this is right where I was thinking. And that, in fact, I ran the numbers myself. There's actually $117 billion in their on the books at the FDIC.
Yeah.
Roughly speaking, as far as I could find in data, and yours might be a little bit different in terms of dates here, but so I ran the numbers, and it was 1.53% according to my calculations here. And so this is proving that point with it being closer to 1.2 on this Q1. My numbers were a little bit older, so this is even more up to date. What does this mean? This means that if 100 of us had a account at the bank, then 1.5 of us would get our money back. If the bank had a bank run today. What does it mean? It means that if just 1.5% of all banks in this country failed, 1.5, how much failed in 2008? It was closer to 20%. So what happened? Go back to that chart one more time, Amanda, and then I'll hush and pass the brownies over to Ben. I want to get Ben's reaction to this. So that chart, if you have it still up, I don't know if it's possible.
I'm working on it.
So 1.2%, but we're there now after a 10-year plus bull market run where banks should have been paying their premiums into an insurance company, which insures their deposits, right? So what happened in 2009 and 10? It went negative. Does anybody remember how the FDIC made good on these banks? What happened? Where did they go for the money? When FDIC is out of cash, what happened next?
I'm pretty sure they went to the government and to get a bailout. Isn't that what happened?
Oh yeah, that's right. Who is the government in this country? Evan's raising his hand. He is the government.
Yeah, who gives the government money? It's more maybe like you can't.
Does the government create anything that develops a profit motive? Does it have any like inventory? No. We, the people, bailed out the FDIC. So who is funding the FDIC's or the bank's mismanagement?
Taxes.
We are. Yeah.
Yep. And Mark,
all right. So are we feeling safe? Should we put all of our money in the banks? Okay. I'm sorry. I'm off my.
No, there was a recent thing that happened this last year that you kind of alluded to in 2023. What was that? What was that event?
Do you want to jump there? I'll pass the ball.
You go for it.
Okay. Well, there's Silicon Valley Bank, and there were several other banks, only a handful, but they were quote systemically integral or important. And they decided, meaning the Treasury Department, decided to go ahead and cover the deposits of people above and beyond the 250,000. So the banks went out of business, but the depositors didn't lose their shirt. Now, I'm just going to say this one thing, and then I'm going to pass the ball over to somebody else because I don't want to keep rambling. I'll pass it back to, who do I want to pass it back to? I'll pass it over to Evan next. So, all right. Why did the Insurance Commission, FDIC, get started? It got started after the Great Depression.
Yep.
And what happened before? We had banks. We've had banks for thousands of years. So what was going on? How did people survive without an FDIC? Because clearly it's working so well right now, right? So what was the survival mechanism of the average bank depositor and practitioner? All of us are bank practitioners. What did we all do before FDIC? Well, we had to use our heads. We had to say, that bank is crooked. I'm not going to put money into that upside down swampland investing bank. I need to go do my due diligence. And the FDIC took that away. I won't say they themselves, but the net effect of the FDIC has basically commoditized the banking world. And now we just throw our money in whatever bank has the highest interest rate. Well, what does that do? That incentivizes the banks to go out and get more and more risky stuff so they can give our deposits a higher rate of return. So we can choose them over the next bank down the street. And ultimately, what does that do when banks take bigger and bigger risks? I'm going to pass the ball over to Evan.
Oh, so if banks are taking bigger and bigger risks, I'd say it's going to get pretty volatile, pretty much anything could happen. And in some instances throughout not so long ago history, it was very, very devastating within our lifetime. Not just like years and years ago. And before, there's been a lot of different changes. I think, to your question, what did banks do? Well, yes, we had, before there was a FDIC and reserve and all this. Well, it was tied to something, a tangible, hard asset like gold. Mm-hmm. And it was to our knowledge, best of our knowledge, it was backed by that dollar for dollar. And you could pretty well count on this actually being worth what it was. Now there's something called fiat currency and, There's all kinds of, it's just a number on a screen at this point. Catacomb XYZ kind of hit the nail on the head with his little printer and a little money symbol there. Is what happens whenever banks start getting into more risky environments? Well, there's bailouts. There's and the bailouts are coming from us. We're having to bail ourselves out by helping out the banks in order to get that. So that go ahead, Brandon.
I was just saying, like, they're playing a different game than us. They can actually do crazy stuff. Like, this is insane. And if it's any original, like you and me level, we would be called nuts for doing this kind of thing. It's not financially sound. And yet that's what our system is. And we wonder why we're all jacked up, right? We're all chasing quick rate of returns, hurt this person to get this thing. And then what's helping build the foundation, that we don't need the foundation anymore, which was insurance, which is what we do, right? And so even as I do this with the banking yourself method, and we have access to the cash in our policies, most of the time I tell people we cannot just take everything out and just go put it into, take a loan and go try GameStop with all of our cash value. That's not wise. We need to keep a reserve, keep a foundation in place, just in case, I don't know, a flood happens in your business or things like that, right? And the problem is, what we aren't doing as an economy or world is keeping a oh crap fund. Now, it might be lazy money. It's okay. But at least we have the fund in place that in case something happens, because there is, I believe, more volatility and more challenges, and we can't overcome those because we don't have the reserves in place.
Why? Can I just jump in here real quick and say, I think most people have this thought that the banks are safe, like, just put my money in the bank, everything's fine. That you don't think about it. Where does this thinking come from too? Like, why do we all just assume banks are it, man? This is the place to put our money. What do you guys think about that?
Because Bill, was it the movie It's a Wonderful Life? Who's that guy that won in the end? The villain. I think the villain took over in some regard. It just becomes natural.
Yeah. We're going to get to, I think, Brian's question in the chat, I think, is awesome. We for sure want to talk about it. I'm going to play a little bit of devil's advocate and like clearing things up, fact checking a little bit. So what we're talking about with the zero reserve requirement is for transaction accounts, or like it's a net transaction account amount. There is another reserve system. And actually after 2008, around the world, like the IMF, like somebody created this tier system, and they require a certain amount of the bank's capital, let's use that word instead of reserves, to be in what they call a tier 1 type of requirement. And they have a percentage, depending on how big the bank is, that whatever their capital is, they need to have this, X percent in that tier 1 capital, which is considered safe and at risk. And the point of that tier 1 capital is if they are taking riskier investments and other things like derivatives and, margin accounts and who knows what else, that they have this backstop to help them get through that. Now, how much that backstop is actually working and all those kind of things is a big question to ask, and something that might continue to get edited as we see different recessions happen and whatnot. But let's define differently what this reserve requirement is and how there's zero reserves required. This is where they don't have to have any money when you come to the bank. That's different. They might have a ton of capital. In fact, the best banks are capitalized, right? Just like we talk about banking yourself. You want to capitalize your bank, right? They have capital. But where is that capital? Is it accessible? Can you withdraw it today at the bank? Not likely, right? And guess where they put a lot of their tier 1 capital? In cash value life insurance. Yeah. That's considered a safe foundational asset for the bank.
Mm-hmm. Well said, Amanda. Thank you for making that distinction. I think that's clarifying for a lot of people. Yeah, their money is different than your money. And so they hold a business called borrowing and lending. They have their own investment portfolio of real estate, and they can invest in whatever they want. And they've made some pretty risky bets per what we just got done talking about. Their incentive structure is all wrong. And so they're incentivized to take those risks. But as far as you're right, as far as our deposits, they then use your deposit, whatever you've got from your employer's paid paycheck, goes right out the door again to somebody else who needs a loan. So
How
imagine,
many times?
yeah,
Multiple times.
yeah,
per
that's a
dollar.
great point. Yeah, Evan. So I put money in my bank. My employer, let's say, gives me a paycheck, and instantly I see my whatever it's going to be. Let's say it's $8,000 this month, or whatever your paycheck is. $8,000. Wait, great. So I'm sitting on $8,000. I look at my account balance and it says $8,000. Is there some shoebox at the bank with $8,000 stuffed in it with my name on it? Anybody have an answer? No. So where does it go? Well, it goes to somebody else who swiped their credit card or got a car loan or something else from that same bank, and it's out the door. And so, Evan, to your point, man, somebody else gets a loan. Let's say it's a business loan. And what do they do with the money? When they get money, where does it go? It goes into a bank account, doesn't it? And so once again, you can continue the cycle where you repeat the fractional reserve ad infinitum, because every person is putting a deposit back into a system that then can be borrowed out again and again and again. So, Amanda, you might have some stats on this. If not, that's okay. Pass it to somebody else. But I can ask you first and let you give us a shot here. What percentage of your deposit is left at the bank? And let me say it this way: is what is required to be left at the bank,
Right.
according to the Federal Reserve. According to the Federal Reserve, as of this year, what is the required percentage of deposits that must stay on the books at the bank from all of our deposits? Okay, thoughts?
Yeah, as of March 27th, 2020, they eliminated all reserve requirements. So that means 0% has to stay there.
That should be the Thanksgiving Day massacre right there.
There it is.
If I'm a turkey, and I probably am, ask my wife, ask friends that know me, I am absolutely floored that we still think of banks as safe. Ben, to your point, man, why do we think banks are still safe? It's the Thanksgiving turkey phenomenon. It's the it's the survivor bias. We've lived this long and it's been fine. And I've only ever seen white swans. There's no such thing as a black swan.
Yep.
I've never seen a Thanksgiving Day. Mark, you're just Chicken Little over here. But if you've got zero reserve, that's a big problem.
It's funny too, because I don't think it's actually zero. Like right now, it could be less because I'm kind of leading somewhere. But what if the banks actually have losses because they're investing that money, and what if the people that they're investing into don't pay it back? Because somebody correct me if I'm wrong, but I think a bank is allowed to lend each dollar that you have in your account. I think it's 10 times. And so, that's a lot of risk. And is it possible that the banks could have losses that are unrealized at the moment?
Amanda asked, where does it all go? And I do want to add something on here that I think is our economy, again, is fake. Like there's a lot of people who are risking, and maybe they're the big guys are doing a whole lot of making a whole lot of money for them. And what are those called where they I forget, man, I'm going blank here. The different day trading funds and all that kind of stuff that people are just investing in crazy, I don't know, different things that I'm seeing. A lot of it's all fake, right? And we're just saying, well, at least I made a lot of money for the short run. And that's what's happening a lot. And we don't know how to think in a healthy way.
Yeah.
Equity, I think. What is that called? Equity? Not equity.
When you're trading on day trading, like high speed trading, do you
Yeah,
mean? Brandon?
yeah.
Yeah.
Yeah. I think there's just a
Yes.
lot of that kind of idea, and fake businesses that are like selling toasters that aren't real toasters, that kind of thing. There's a lot more of that happening, and people are doing that. Banks are doing that, and most of it's not even
Right. Right. Well, there are a lot of bank losses happening right now. There's there's an article that we can put up here soon it shows a 1.7 trillion dollar on the books of the bank's balance sheets. Okay, so not our transaction account sheets, but the bank's own sheets. There's still they papered over the problems in spring of 2023. They loaned a bunch of money to these banks. Many of the it was over 800 banks that required a loan. And so now it's coming due a year later. And where are those balances? Well, there's still a $1.7 trillion loss on the balance sheet. And now people have less and less depositing. We're going less than, many Americans are facing a shortage of savings. We had a surge after COVID of significant savings. And since then, we've now gone down to the lowest savings rate that, is on record. And our credit card balances are higher than ever. So, you've got kind of a tinderbox essentially. It's the day before Thanksgiving in terms of the banking. So, I don't want to be Mr. Doom and Gloom here, guys. We are all Bank on Yourself professionals, and we're all colleagues helping clients serve and solve this problem. I know a lot of people's questions, including Brian's wonderful question. Maybe we start addressing some of these questions and talk about where and how banking on yourself and becoming your own source of financing solves the problem, and where we're still exposed to any issues in the banking world. So I can read Brian's question, and I'd love to know, Evan, maybe you can take a stab at answering it. It says, let's say, this is Brian Klaus. Thanks, Brian, for asking this great question. Let's say I've been a not so average financial practitioner and put my money in a Bank on Yourself designed policy. If the banks fail, how do I get access to my well-saved money?
Yeah, so if all of the banks fail, and what happens whenever you take a policy loan, and you request from the insurance company to send you some cash value, some of your cash value, or leverage it. So you're getting a loan directly from the insurance company, and they have money in their banks as well. So what if their banks fail and all of this and that? There's a lot of threads that you can pull on there. At the end of the day, the insurance companies they have a huge portion of liquid savings, like liquid funds available, liquid capital, not savings necessarily. And that's in order to pay out death benefits, to be able to lend as policy loans, so on and so forth. And they're held to extreme requirements, much more rigorous than the FDIC requires. And in this case, it's typically dollar for dollar. What they're able to lend is what they have to have in reserves. And so it's backed by more money, everything, by the amount of death benefit that they're going to have to pay out. Now, if you have a policy loan pending, the insurance company is going to ask you two questions. Does somebody say what they are? What are the two questions they ask?
How much do you want? Where do you want us to send it?
Where do you want us to send it? So you have to, you're going to have to figure out where you want it sent. And that, I don't know, if your bank has failed, then whatever bank that you're sending it to is going to need to be a reliable bank. One that hasn't failed and one that's not going to fail, at least long enough for you to get your cash out of their account.
Absolutely.
Add to that, if you will.
Let me add to that, and then I want to get anybody else's thoughts too. So you're right. So there are, as someone said earlier, it was Tally maybe, there were 4,000 something banks, total banks in the system. And so if all 4,000 or every bank in the entire world would have to be out of business in order for Brian's great but apocalyptic style question to come to pass. Because as long as one bank is still open in the entire world, because these insurance companies can deposit money into any bank in the world, including the United States, including out of the United States. As long as there's one bank open receiving deposits, then open up accounts at that bank and direct your policy cash into that bank. Now, let me say one more thing. If every bank has failed, Brian, you and I are going to call each other and we are going to start a bank business. Okay? Because we would make a ton of money if every bank was out of business. Brian, call me first. Okay? That's all I ask.
Well,
Because
can I ask
there's a demand there, supply and demand, right?
Can I ask a question on this? So right now we're getting it where it's almost like that too big to fail. And then if the big guys keep going and we are okay with the small banks failing, or the kind of system that's in place where it's a lot harder to start a bank when you're small, or a business for that matter, right? And so what do we do with that if it's keeps going as bigger, they have less that they have to have, and they can do more crazy stuff. Us as the little guy, what do we do about that? Like, how do we, and I'm asking for real, like, how do we change our behavior? Do we work with the small bank? Is that better? Even though their rates may be different? Is it like, how do we
It's sort of
change?
hard to, yeah, Brandon, you're bringing up a good point. There was again, incentives really matter here. Last spring, it was almost as if we were punished if we had small banks. I like small banks. I think but think about it. They were willing to protect our deposit above 250K if we had a, quote, systemically important bank, according to Janet Yellen, no relation to Pamela Yellen, by the way, in the Treasury Department. So interestingly, there's an incentive now for folks to run to the mega bank if they've got a balance bigger than 250K. And I know that sounds like a lot of money for a lot of people. It really is. But if you're even a small business, you might have months where you're running payroll, you got inventory, you might have a balance way bigger than 250K, even temporarily. So you need to have your money in a mega bank. I hate saying that. But that the incentives are all upside down. It's not true free market capitalism. It's a corporatism. It's cronyism. It's so many things, but it's not. Pick your best bank based on the prudent balanced nature of the bank's investment portfolio and more. It's all about like upside down incentive structures. Ben, I'm seeing you thinking deeply, my friend.
yeah,
I think you've got something really good to share, my friend. So
I'm just looking at all these great questions. I mean, Troy just asked, where do the insurance companies keep their funds, or is it just numbers in the cloud? So I think that would be a good one to tackle. Tally said, are the banks that insurance companies use different than the ones that consumers use? And them just going. So I'm just reading these great questions, and I'm almost zoning out on what you guys are saying, and the thoughts are floating around here. So
Amanda, you look like you had one. You wanted to jump in and answer some of one of those.
Okay, Ben, you and me. Here we go. If you look at the balance sheet of a life insurance company, what's one of the biggest things that they own, that they keep the general fund put into to help grow it? At least the ones we work with Bank on Yourself.
So, so insurance companies, we're not talking about where are they putting their money, right? Are they putting it into Swampland in Florida or Bernie Madoff? Like, where is this money going? So what they do is, they invest premiums primarily in investment grade bonds and alternative assets that have regular cash flows, like commercial mortgages and infrastructure debt, right? Or they also, but then what are they avoiding? They're avoiding the volatile investments like stocks, and they manage their risk appetite to ensure that there is solvency and the ability to pay claims. They have stress testing, so we're talking, are these, I'll throw it back to you, do they have reserve? Do they have reserve?
Well, yeah. Well, let's talk about those bonds for a second, because you use this word bonds. I wish we had an economist here, because they would make a very clear distinction between what is a bond and what is money. currency. There was actually an economist back in the day. I don't remember his name right now. I'm horrible with names, but he did a thought experiment. What if we were buying groceries at the grocery store with bonds? How would our economy change, right? We're not using a fiat currency anymore. We're using a bond, right? That you can't have, leveraging against, all those kind of things. And he made a very clear distinction, like bonds are not the same as fiat currency. And so when there might be a bank as a middleman, right? That unfortunately we still live in a banking system. We've adopted banks, like we're going to use them for convenience. But then when that money leaves, what's it doing when it's in that bond? It's funding research, development, building bridges, helping companies develop new products, paying their R&D people actual salaries. It's going to work in the economy in some really cool ways. And I've heard the iPad was developed with a life insurance money. Like we have cool products because of these types of bonds. Like that to me is saying something totally different than if that money was at a bank hanging out there, maybe even earning the same amount of interest. What it's doing in the economy is something different. And am I way off base here? I know we're not economists.
That's really cool.
But that's what I've come
Amanda,
to understand.
I'm thinking a lot about your comment about bonds at the grocery store. I just thinking, it's different. It's different layers of example to which, again, the book, David Graeber's book, Debt, the First 5,000 Years, which I've probably mentioned 24 times on various shows here. And I don't agree with all of his conclusions, but I do love his title a lot because it just reiterates how permanent the concept of debt is in human interaction. If we're going to have civilization, there's going to be debt. Well, bonds are debt. That's kind of what bonds are. Stocks are equity. Stocks are ownership in a company. Bonds are you lend money to that company. That's kind of the opposite of a stock, stocks and bonds. So interestingly, I like your idea because it's the regular obligation to each other that creates a cohesive civilization. So I owe my parents the very life I have, right? So it's a bond, you might say. It's a family bond, and then there's corporate bonds, where we lend money so we can build an iPad or build a road or whatever else we want to do. And so insurance companies are built around that bond mindset rather than just quick cash overnight investments, meme stocks, and whatever else. In fact, insurance companies are regulated against such hot stocks and certain systematically, like I think structurally problematic or problematic investing. So Amanda, did you have anywhere else you wanted to take that? Because it sounds like you were moving in a pretty cool direction there.
There you go.
Sorry. Troy, your question. Yeah, these insurance companies heavily regulated, so they can't just put all the money in one bond.
Yeah, it has to be at least diverse. 1,000. So I'm told anyway, and researched a little bit on that. You have to have at least several hundred to 1,000 different specific investments or bonds. Yeah.
Mm-hmm.
Yeah. And before we leave the bond topic, sorry, Brandon. If you look at what companies have been issuing bonds and for what reasons, if you are all concerned about climate change or just environmental sustainability, a lot of bonds have been issued by large companies to help them invest in the long term, right? We're talking about 30-year corporate bonds that they can pay back a little bit at a time over 30 years. That allows them to do some really cool things like install solar panels and, save a lot of money, make their plant zero emissions, things like that. I think that's really cool. And they're doing it in a way that it's not costing taxpayers, or they're not taking government incentives to do it. They're actually borrowing to make these improvements to save them money. That's a beautiful thing. Okay, go ahead.
I was just thinking some of the deregulation, some of the switch with banking and insurance, and then a lot of my big thing I was thinking about is when you go into the CNN money, it's greed and fear. And are we on the greed side or the fear side? And this is our economy. This is our banking system. This is Wall Street, greed and fear. And Amanda just released an episode, The Human Psychology of the financial system.
It's a
right?
great episode too, by the way.
And I think that honestly, some of that is thinking about that, the human psychology that is happening. And a lot of this is being confiscated out of us, right? We don't even realize that it's happening. And it's been happening by the people and institutions that we think are foundational to us
Yeah.
and trust. And they've done some things that have, in the name of profit, done some crazy things for their own bottom line. And again, that human psychology and not realizing we're all being played here. And the insurance companies, in my opinion, they still have to be in the game, right? But they have a longer game. They need to be in the game for hundreds of years, right? And they can't just say, well, let's just put it all in black and hope for the best, and we'll get a bailout, because they are the bailout. Like, when you said with the insurance, FDIC insured, they are the foundation. You can't erode the foundation. What for us and what we do with our work is we are foundation builders, not risk takers. Maybe you use the policy a little bit for that, but really we are helping build a foundation. The problem is in our world, we're saying no risk, no reward, blah, blah, blah. And we need to go back to foundation,
Well,
and corporately.
And to that point, like, there's a quote by a guy named Jim Rohn, who I wish he passed away before I had the chance to meet him, but would love to have met this guy. He says, you can't change your circumstances. You can only change the set of your sail. And so, to address some of the comments and the questions, hopefully kind of as like a blanket disclaimer, like we're all in this together. And we can't really change the circumstances as an individual necessarily, but we can change how, what we do with those circumstances and the direction that we head. So the point of all of this is to not say everything about fiat currency is evil, everything about, because I've actually been on the benefit of receiving loans from banks where I'm certain they were creating fiat currency in order to do that. And it helped me grow my real estate business. So I'm not like that was, to me, was a good thing. So, maybe not great for the entire economy, but at the end of the day, it's the circumstances, it's the environment that we're in. And we just have to figure out how to make the most of it and to protect ourselves in the worst case scenario. And this definitely, bank on yourself, definitely is a huge asset whenever it comes to protecting yourself from, having a crumbling foundation.
So yeah, you guys, I think you're bringing up some great hopeful points. And, I think the interesting thing here is we don't have to put our hope in the banking system. And many people don't realize where they're putting their hope. But where you put your heart or your hope changes your life. It really does. And we can say this on a religious and spiritual level. And I would add to that a financial layer as a glisten on top of that as well, right? Where you put your money makes it act differently, like Ben said so well. But it also makes you act different too. And when your money is in a system that, like it or not, you're like, I don't really know what they're doing with my money. That changes how you sleep at night. It changes how you talk to your spouse. It changes your life expectancy. According to the Journal of American Medical Association, a wealth shock can increase your likelihood of being admitted to the ER. Okay. So the good news here is you don't have to wait for Congress to pass some law. You don't have to wait for your guy or gal to get into the right spot in office. Every day, the folks on this video here are meeting people one-on-one, family by family, tribe by tribe, getting people out of dependency on a federal deposit insurance commission that has no real reserve, a federal reserve that's not federal and has no reserve, a banking system that is like a paper tiger, and moving people's real hope, wealth, whatever you want to use there, into something that has some legitimate, like contractual, there's the word I'm looking for, civilizational contractual permanence to it. Now, could anything totally eviscerate the bank on yourself and the insurance industry? Sure. I mean, the end of civilization, it's coming someday. I hope, God forbid, anytime in our lifetimes and even our grandkids' lifetimes. But contracts are going to persist, like bonds are a contract. Real estate is a contract. Life insurance is a contract. And so where you put your money, if you choose to do a bank on yourself design policy, work with a bank on yourself professional. There are too many knockoff people out there who are running wild. I hear it all the time now that I got to keep preaching this. But go back as far as Thomas Jefferson. And he says, if the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. Now, that was Thomas Jefferson saying that. Isn't that prescient? Isn't that exactly right? Isn't that him pointing to Thanksgiving Day? So don't be a Thanksgiving Day turkey. Keep your eyes on what's most important and put your money where you're going to be safe regardless of what banks decide to do next. I'm off my soapbox, I promise.
Way to go, Mark. Way to go. Could somebody just respond to Troy just in the comments? I will, so Thomas Jefferson might be too far in the Wayback Machine for folks. I'm going to make a recommendation for people that really want to nerd out about banking and its influence and what is possible on a policy level, not just an individual level. I would recommend this book. It's called Goliath by Matt Stoller. It's a pretty thick one. Audible,
It's
right?
all
Like it's
reversed
good.
on our.
It's pronounced
But it literally tells the story of a congressperson who called for the impeachment of the chair of the Federal Reserve. What? That's possible? Mm-hmm. Yes, that's possible. That's happened before in American history in the 1940s, I believe, if I remember correctly. Yeah. So pretty good deal there. We could keep going, but I think we're done now. Thank you all for joining us. Thanks for being here. Evan, Ben, Brandon, Mark, so glad to see you here. Everybody that's joined in for whatever period of time, all the people watching the recording, thanks so much. Be sure you hit subscribe so you don't miss our next live that we do, as well as the content that we drop in between now and then. I know with the Not Your Average Financial podcast channel and the Wealth Wisdom Financial podcast channel, we drop things all the time, and it's content that you can't find anywhere else.
Did we enter Troy's? If Troy,
I think we're going to put it in the chat. Troy will answer you. Actually, I'll go ahead since we got a second here. Troy, anybody of any age can get a policy. That doesn't mean they're the insured on the policy. The owner and the insured can be different people. So I could be 120 years old and on my deathbed, and I could still buy a policy with Brandon as the insured, assuming he's younger than me by a lot. So don't let age or health or any other reason count you out from looking into this, following up with one of the people you see on screen here. And if you followed up with one of us before, reach back out to that same person, and I'm sure they'll be able to help you. And that goes for everybody else too.
Thanks, guys, for being here. There's going to be a lot more fun coming. As you can see, we're expanding the movement. So let's grow this thing.
All right.
Great. And I give you all a heads up. I'm not going to be here next time. I'm finding a lady to stay in my stead. I'm going to a women leadership summit with a life insurance company. Cool. I'm super excited about it.
All right.
Yeah. I'm sorry. You all weren't invited.
Well, all right. Thanks, guys, for being here. We will see you next time.